Okay, ladies and gentlemen, thank you very much for joining us to another virtual roundtable of the IWS, the Internationale Wirtschaftssenat, with a very, very interesting topic today, finance. And in order to give you some food for thought and sort of start a discussion after the impulse speeches of the individual speakers, Professor Kooths will lead you through the hour of this virtual roundtable. And I would like to introduce the three speakers. Number one is Professor Dr. Meyer, who's the founding director of the Flossbach von Storch Institute and former head of Deutsche Bank economy department, or the chief economist. Second is Mr. Chris Polk, who is the private wealth manager of Morgan Stanley here in the United States, and will give us his perspective on the developments in the finance world. And last but not least, Professor Jörg Rocholt, who is the president of the ESMT, European School of Management, and also a professor in sustainable finance. And I would also like to introduce the host and moderator of this discussion, Professor Dr. Stefan Kooths, who is a member of the executive board of IWS and also the vice president of the institute in Kiel, focusing on business cycles and growth research. I'm very, very happy that we have such a large number of participants, and I would like to open the floor to Professor Kooths to lead us through the hour. Thank you very much from IWS and the management board, and we're looking forward to a great discussion. Thank you.
Thank you very much, Thomas. It's my pleasure, to open this debate on a quite comprehensive subject. We're talking about energy prices, the energy price crisis, high inflation, the euro development, and the changing world economy, gloomy prospects for national and international finance, ? So quite a comprehensive subject for 1 hour. And we try to open the debate with some kickoff statements in alphabetical order. Therefore, Thomas Meyer, in this case, please start with your contribution.
Thank you very much. Hello, everyone. When I look at the present situation, a word comes to my mind that I picked up, which is apparently used at the US War College, which is VUCA. Volatility, uncertainty, complexity, and ambiguity. This is about what I feel presently characterizes our environment. Many risks exist. There is the geopolitical risk, there is the energy policy, technological change is a challenge, migration is a challenge, climate change, economic recession. But I will look at it mostly from a financial perspective. And from a financial perspective, from my point of view, I think what concerns us most is the return of stagflation. So I'll focus on that. Now, many economists regard the return of inflation as a result of a series of economic shocks that could not be predicted, basically random shocks. But my point is that the stage for this inflation was set by the central bank's easy policies years before, and in particular the submission below fiscal policy during the pandemics. Western central banks, I mean with that largely the Americans and the Europeans, have financed a large part of new government borrowing during the pandemics. When I look at the big banks, the two big ones, US, Eurozone, you will see that the US, the Fed funded about 60% of new government bond issuance. Indirectly, of course, directly they are not allowed, statutes and so forth, but about 60% of new bond issuance in 2020-21. The European Central Bank went to 120%, which means that they did not only fund all new bond issuance of the Euro states during these 2 years, but they took 20% of that sum out of existing bonds in the hands of the investors. So my assessment is that with this, they created a monetary overhang, which we only know, or we only have experienced in the past during wartime. So more money exogenously increase in money supply than there is a demand. And we recently did an estimate how much this could be, this monetary overhang. And we come up with about 26% of the fundamentally justified money stock in the US and about 22% in the Eurozone. Now, when we look at the history, we can see that such monetary overhangs have the potential of fueling inflation. I emphasize potential. Yeah, it's the potential. It's not a forecast that I make, but the potential of fueling inflation. And I recently tried to estimate what the potential could do, and I come up with a simulation analysis from a simulation analysis with the result that this has the potential of funding about 6% inflation per year in the US until about mid-decade, 2025, and a little less than 5% in the Eurozone. It's a bit like a car that has a full tank, and you want to estimate how far can I go with this car at what speed. This was the exercise, and this is the result. I think there is no sign presently that the central banks are really willing to stop this inflation potential, to reduce it, I should rather say, because that would, in my view, require positive real rates. In other words, nominal rates above the inflation rate, and we don't see that. So with the economy weighed down by the numerous risks that I mentioned at the beginning, and with that inflation potential that I believe will materialize itself in the next years, I think we face several more years of stagflation. This has important implications for society and financial markets, but I leave that here. I end with this remark, just saying this is an enormous challenge that I see, and I think we can discuss what sort of challenge this may bring. Thank you.
All right, thank you very much, Thomas. Sorry, I had some connection problems in between, but hopefully I got the key message that you sent. So let me hand over the floor to Christopher.
Thank you very much, and it's really a privilege to be here before or with all of you. I wanted just to start with a couple disclaimers. First of all, these opinions are certainly mine, not necessarily 100% Morgan Stanley's, although many of them are similar. The second point is I have a very clearly US-based perspective. That is my whole business professional view. And I use US-based examples and data and observations for my opinions. I have basically a 2 to 3 year time horizon, and my primary lens through which I look all of these things is how do I make money, not necessarily is it right or wrong. So I view the world through two different lenses. First is what I would call the real economy, and I think I agree with virtually or everything that Professor Mayer said. I see it exactly. The numbers are fractionally different, but in any event, the same thing. And that's the real economy. And then the second lens that I view things through is the financial markets or asset prices. And the real economy, fundamentals, inflation, debt over the next intermediate time frame. Financial markets are driven by liquidity, capital flows, price movements, and I view that 3 to 12 month type of time horizons. And from my view, I always look for where there's a gap between where I think things will be versus where the perception is today. Over the next 2 to 5 years, I think we will have inflation in the US higher than people expect, like we just heard. I think we're going to have higher energy costs because I think demand continues to increase, and the ability of the Federal Reserve or any central bank to actually mitigate that is limited, if at all. I think we will also have lower interest rates. They will go up, but then they will have to go down because the global debt is so large it can't sustain itself. And I think the currencies will, it will be country by country and how they react to the overall economy, the global debt that they have, their ability to service that debt, which is going to be very severely questioned over the next 5 to 10 years. But in general, I think the real economy is relatively strong, although I think stagflation is a very real possibility. We do think that inflation will be above interest rates for the reasons that you heard. As far as the financial markets, we think there will be, continued volatility, much greater than in the last 5 or 6 years, but I think more consistent with the last couple. Most of the people trading financial markets have never been through a rising interest rate environment. And most people really think that the Fed is going to be able to dictate what's going on. The U.S. Congress has not passed a budget in 8 years, and the world is looking for the Federal Reserve's interest rate policy to solve all the problems of the governments across the globe. I don't think it's going to happen. As far as energy, I think the short-term prices will be affected by things like supply chains, government regulations, and business managers' outlook. But longer term, it's going to be driven by supply and demand. The hydrocarbon business is one of the most, if not the most efficient global commodities. And these cycles are long. There's long cycles. We use 101 million barrels a day globally, and we have been matching this, production and increase in demand almost exactly for the last 5 or 6 years. And now we have severe shortages in production capability due to a lack of investment and then political and environmental headwinds. The U.S. inflation normally is driven by employment, housing, and food and energy. The Bureau of Labor and Statistics in the United States continues to manipulate the definition to make it less painful. And most recently, as an example, they redefined how healthcare costs are being rejiggered. One of the reasons why it was a surprise down was because now they're defining healthcare costs only by what the individual pays out of their pocket, as opposed to the total cost that's actually being experienced systemically. Healthcare in the United States is 20% of the global GDP, and these costs have just shifted. They haven't gone down, but the government, because their cost of living adjustments and debt expense is all tied to inflation, they continue to manipulate that lower. Finally, currencies is probably my weakest topic. I don't know that much about it, although it's obviously incredibly important. I do believe that, as we both said earlier, the amount of global debt, government debt, the ability to service the debt, the United States continues to be in the catbird position because it's the world's reserve currency, and what they do impacts everybody else and probably will be to the negative of other people. So that's the summary, and I'll turn it back to you, to Professor Kooths.
Thank you very much, Christopher. And this brings Jörg into our round. Please.
Sorry. Thank you so much for inviting me. It's really a great delight to be part of this group, and at the same time, it's also a great challenge, given that I had two so sophisticated speakers ahead of me. So therefore, it's important to think of what actually could be another perspective, because two of the elements that Thomas and Christopher mentioned are, I think, extremely important to understand the current situation. The first one is uncertainty as opposed to risk. So basically using the Knightian differentiation between risk and uncertainty, I would certainly think of this situation as one in which uncertainty plays a huge role. And this translates exactly right away into what Christopher mentioned, volatility. So this means at this point of time, we have a situation in which already small pieces of news may relate to actually significant fluctuation in stock markets and financial markets. And this has to do with the fact that we have a very high level of uncertainty at this point of time, which brings together different elements, different shocks, or you could say different longer term developments, which would go beyond, say, the short impulse I should give. But let me just mention a couple of them to explore this. First, we still have to suffer and we have to still deal with supply chain shocks. So we see this, for example, among car manufacturers, that they still have to decide where to use semiconductors best, in the high margin or the low margin products. We see this, and this I think goes back to what Thomas said, that already last year the inflation started picking up, even long before the war started, simply due to the fact that also government stimulus packages were completely overblown. So we saw that in the United States, Larry Summers did the back of the envelope calculation where he said 100 billion per month is brought into the economy as a stimulus package. And at the same time, there are only 25 billion of losses. So combined with the first element that I said, he basically said we saw a real wave of demand hitting a very stiff supply wall. Then on top of that, obviously comes the war, which just intensifies problems, also when it comes to inflation, in particular when we think of the energy prices. So this is very much an additional element that comes here. But then, and we shouldn't forget about that, there are a couple of other aspects that we should also keep in mind. The one is certainly the, so to say, geopolitical tensions that go beyond Russia. This has particular relevance for Europe, for Germany, when we think of the relationship between China and the United States in terms of export markets and other parts. We also should keep in mind, and this is maybe a little bit of a paradox at this point of time, or may look as a paradox, that we are in the middle of a very significant demographic change, which may maybe affect the United States less than it affects, say, Europe, Germany in particular. This may also explain that labor markets are pretty robust at this point of time. And may explain that companies still have a hard time to find qualified but also non-qualified labor to really keep up. Finally, and this is a difference that we face now in comparison to the start of the corona pandemic, that central banks can't just accommodate anymore. I mean, they need to really stop and they need to basically be contrarian at this point of time in the way that they really need to fight inflation. They can't continue what Thomas mentioned. They can't continue to keep interest rates low. And maybe even more importantly, they can't continue to buy or to conduct asset purchases. So therefore, it is a situation driven and determined by a lot of volatility. And I would say, if I should summarize it in one word, so basically coming out of the VUCA that Thomas mentioned, in one word, it is a high level of uncertainty leading to basically analysts to look so carefully at just little pieces of information that maybe can help to figure out how things might develop.
Thank you very much to all the three of you. Well, I learned uncertainty and volatility is one of the big topics, obviously. And the question is, where does this uncertainty come from? And my thesis is it primarily comes from policy uncertainty, doesn't it? And this is that I would like to ask my first question about. And before I ask it, let me also invite all the other participants here. Please raise your hand or give us a quick comment in the chat parallel to this video session. If you have questions that you would like to address to one or all the three of our speakers. My first question, again, coming back to policy uncertainty, is on what we currently discuss under the umbrella of making our economies more resilient. This is basically all over the place now, the top subject that policymakers are talking about. And behind this, making our economies more resilient, there is a lot of interventionism and even protectionism that might make the whole world, at least the Western part of the world, even more fragile than it already is. My question to all the three of you is, resilience is about fragile or making economies more fragile more robust vis-a-vis fragile value chains. But isn't this also a task for the participants in financial markets? Isn't it their job to be the watchdog and to look at corporates? Are they really exposed to high risks due to a high degree of specialization? Is it, for example, one reason why German car makers are not very much appreciated currently in the capital markets? Is this already a significant discount due to their huge exposure to the Chinese market? So can we rely on capital markets to already guide corporates to more diversification where it should be, and to prevent them from over-diversifying where it should not be? Or do we need extra policy interventions here to prevent countries, large companies, to run too huge risks with respect to their value chains? Or are we overdoing it? Are we putting corporates into a too narrow framework that does no longer allow them to take sound business decisions? Let's start with you, Thomas Meyer. What's your take on it?
Yeah, lots of points you raised, so let me try to address a few of them. I think what Jörg said is very important. We need to distinguish between uncertainty and risk. Uncertainty is what people used to think about, and Frank Knight called it immeasurable risk. And this is what we generally deal with, I have to say. But we have developed thinking that we can measure risk. In the financial markets, this came about with the advance of economic science in financial market management, in asset management and financial decisions. The financial economists among us will all remember the rise of modern finance with the different characters. So we have developed a attitude that we can measure risk, and when we can measure risk, we can push the system to its absolute limits, right? Because if I can measure my risk, I can raise my leverage. Because I think I can exactly know what is at risk, and then I can increase leverage and I can control it. But I can measure, I can also control. I think this is a deep illusion that we have fallen under. So in financial markets, now we have all this idea that we can measure risk, value at risk, the thing that I've seen implode. All these things. Now, the state is important in this because, especially in Europe, especially in Germany, the state has taken on the role of ensuring everyone against risk. We have the Versicherungsstaat, the insurance state.
But isn't this extremely dangerous?
This creates fragility.
Yeah.
You think you can measure risk, but in reality, we live in a world of Nietzschean uncertainty that you cannot measure. But we have, as in the private sector, notably, I work in the financial industry, so there I know a bit more, but elsewhere as well. We have created the notion that we can measure it, we can control it, and then we can have it. And in the political domain, we have established the feeling among the electorates that the state is there to insure us. It will take on the risk. And this creates tremendous fragility because we cannot measure the risk. It's unmeasurable, as Frank Knight said. And with this fragility, right, we then see all these things all of a sudden fall apart in this fragility. And you mentioned the corporates. Well, the corporates have benefited from the insurance of the state, right? In Germany, you can insure your exports. You can insure your investment. We have a bank, Kreditanstalt für Wiederaufbau, which is active in this. So the state is inviting people to take risk implying that it gives the insurance. Now, I'm not saying I'm against insurance, but we have overdone it, right? And with this, we have created fragility. So what should we do? Robustness and resilience, you mentioned. This is basically what we need to come back after we have realized that we have created a fragile situation. Robustness basically means that I can take a hit. Think of a boxer who is not knocked out immediately after he's taken a hit. So robustness means that you have not high leverage, you have acceptable leverage, you have a robust business model that is not at the cutting edge of competition, where a competitor is really hard on your heels, all these things. But you can always err. You can always make an error. So therefore, you need resilience. What does resilience mean? You have to be able to start fresh when you have made a wrong decision. So not putting everything in one basket. Yeah. If one of the things go wrong, you have to have the strength to try again. Right. Mm-hmm. This is resilience, and we have really, really neglected both. We have neglected robustness, we have neglected resilience, and we are now sort of seeing the result of it. So you ask very specific question. I'll give you a very general answer, but I think you can break it down for all the different areas that we see: economic policy, the corporate decisions, and the financial markets.
All right. Thank you, Thomas. Christopher, what's your take on it? You are exactly in the position. You're the private wealth advisor at Morgan Stanley. Do you need the government to make sure that the corporate sector in total is robust enough, or would you see you in the driving seat here to make sure that you invest only in those corporates who are by themselves resilient in the sense that Thomas just explained?
It's a good question. I do manage portfolios. I get measured every day, although I measure myself over the period of years. And I'm either right or I'm wrong in my client's benefit or not. I think it's a huge mistake to rely too much on government to be the final arbiter of what's good or bad. I can tell you just in the U.S., the disastrous policies that most politicians make because they're completely uneducated, wildly ignorant on basic economics. And I'm sure that's not just the United States, but this is what I see all the time. Some of these people getting up there, Joe Biden is just the worst example. He's the most public of somebody who's completely inept. And he's advised by, whomever he's advised who got him in. But these policies, as we're talking about, this enormous waste of money with the fiscal thing. So if you're a company, I worked at Citi in senior management for a while, and the first job was not to get put out of business by the regulators. So your first master is the regulators, and the second master is whomever's going to boycott you publicly and create a reputational problem, because banking and lending and so many other things are based on trust. And then you get down to the customer loyalty and employees and what have you. But now I'm much more Darwinian. I think there has to be a social net, but it has to end at some point in the United States, and I think in Europe and other places. Governments, the more power they have, the more control they have, the more money they spend, the more power they have. And that's their end game, is to have more power. And that becomes very dangerous. And every, dozen years or so, we have this exogenous shock that people didn't expect, and people get hurt. The UK, the gilt market, nobody knew that these derivatives were in the fixed income market, in the pension schemes, what have you. So I'm a big believer in every once in a while, some people have to fail in order for the rest to succeed. So I'll pass it back to you, Professor.
Yeah, do we have the failure climate, the failure culture that it needs to run the prosperous economy?
Not right now. I think that too many people feel that, big government is going to save them. In the United States, that we're looking at paying all the tuition bills for all the college people. It's over $1 trillion. Nobody wants to pay any money. Everybody thinks it's free. When these stimulus checks came. I had clients of mine said, "Oh, free money." I'm like, "You got to be kidding me! I can't have you as a client if that's what you think." In any event, my personal opinion is we need certain bad actors who act irresponsibly to be put in jail and go bankrupt, like Sam Bankman-Friedman and these other people that just risks lots of money. They need to be taken out. There needs to be an example. We need to be reminded there is a benefit to being fiscally responsible. So I don't know if you could tell how I feel about things, but forgive me for being a little heated about that.
No, it's totally fine. Jörg, your take on it.
Well, I can just build on this. So allowing to fail is the fundamental principle of a market economy. If this doesn't work, we actually really get into deep trouble. Because then all these quests for, say, privatization of profit, socialization of losses, really becomes or gets into at the core of the system, and that would, for example, really bring significant problems to the pricing of assets or the pricing of, say, sovereign bonds, pricing of assets in companies. So this is a very important element to always keep in mind. And so you could say it's a fundamental principle we need to keep in mind. Now, I'd like to maybe add one or two thoughts on the diversification part. The diversification part is obviously, you could say, another fundamental principle of financial markets. This is what all our models are building upon. So when you think of Markowitz, if you think of the capital asset pricing model, this is all at the heart of it. Now, there is, though, in the corporate sector, maybe also the need to differentiate a little bit more also on the government side when it comes to purchasing and selling markets. So what we've seen in Germany is the over-reliance, the lack of diversification when it comes to gas imports from Russia. This situation is a little bit different from what we see when it comes to the situation in China, where it's also obviously on the purchasing side, but it's also, and much more importantly, on the selling side. And this differentiation between, say, purchasing and selling markets should be taken into account when we think about differentiation. But there's one element which really worries me more at this point of time, in particular when it comes to Europe. And this might be best exemplified, but it's just an example by the decision of Linde to not be listed anymore in the German stock exchange, but rather to go and take the listing to the United States, which sheds a rather, say, negative light on the development of capital markets in Europe. Put differently, it's actually one of those elements that we need to put most focus on. How can we finally develop capital markets in Europe that are integrated, that are strong, and that also can foster the new level of growth? And I think this is an element which is not yet where it should be in terms of the political agenda. And I hope maybe also by our discussion here, it could become illustrated more and be seen as a fundamental part to have a look at.
So could it be that we in the Western world have kind of forgotten about the root causes of our economic well-being of the past? I mean, you mentioned that capital markets are really important actually, if things go wrong in the capital markets, it's hard to imagine how things can go well for the economy as a total, right? So if you're channeling capital to the wrong uses, well, then obviously you're undermining your overall wealth model. But do we really live in a European context where we want to make capital markets stronger? If I think of our government bond markets, we declare government bonds of all Euro area member as risk-free by definition. How then can capital markets play a role as a watchdog to say, okay, we still believe in the fiscal solvency of individual countries, when we at the same time say that no individual member country of the Euro area must go bankrupt. So we are not really accepting the rules of the game, but this game was our growth engine of of our past in our market economies, and we are kind of trying to switch this off. We are typically relying on our price system to help us to cope with scarcities. What do we do in the energy crisis? All over the place in the European Union. It's less so a subject, I suppose, for the US, but here in Europe, we are talking about how can we play down the role of the price system. We try to reduce the impact of prices rather than to play with the market system. So is this a general problem that we have lost track of what are really the root causes for our prosperous economies?
Yes, if I may jump in there, I don't want always to be the first one, but I go ahead and would encourage the other ones to also do this. But I would say yes, we have lost our cause. There's this wonderful book by Benjamin Friedman, Religion and the Rise of Capitalism, which shows where the strengths came from. Right, these were British anti-Calvinists who say it's good to pursue your own goals, your own interests. Not Adam Smith. It's not in the. It's not for the benefit of the customer that the butcher or the baker produce their products. They do it for their own benefit, but out of that comes some positive result for society as a whole. This was a great insight in this, and it rejected the Calvinist predestination theory, where people are sort of thought of in terms of collectives and not as individuals. Great achievement, and we had then similar developments in the US. The so-called Gospel of Wealth, you can read it in Friedman's book, where they say, yes, if people pursue their own interests, capitalism is a good thing for society as a whole. Good. That was then a little bit, I would say, put in perspective during the Roosevelt years, right? And you can say that out of the Roosevelt years came a basic welfare state. And that was imported in Germany through the US military government, basically. And we started out with a basic welfare state, but largely a market economy, and that brought us wealth. What I see, and we can say peak liberalism was in the 1990s. 1991, the end of the Soviet Union, that marked peak liberalism. Fukuyama said the end of history. Was not. Ever since, we have seen a liberal recession. Collectivism is coming forward, not only in the economy, also in general policy, identity policy. No? That's collectivism. It's not the individual anymore that counts, but it is your membership to a certain group that counts. And this is eroding our strengths. So I would say we have a liberal recession. We have a market economy recession. And you can say that maybe the outlook is totally bleak. But having made that statement that we are presently probably in the recession, you can always also say when the night is darkest, there is some daylight not so far. And in this regard, I would say what we have seen with the Russian aggression, the Russian war in Ukraine, and with the failure of the zero-COVID policy of Xi Jinping, and the problems, the creaking Chinese model, the oversized real estate sector that now needs to be scaled back. This allows us a chance to reconsider our strengths. Mm-hmm. At least, we realize that we have something that makes us far superior to these collective systems. Mm-hmm. I think it dawns a bit on the people, at least I tell myself, it may dawn on the people when you see the Ukrainians fighting for their liberty, my God, giving their lives to live in a free state for freedom. I think that should inspire us. So I'm not totally downtrodden, but I realize that we have come a long way from peak liberalism and appearing, hopefully, bottom liberalism. Right, and a new upswing, but that's my hope.
Yeah, I couldn't agree more. So the battle of ideas is everything but over. So ideas is what drives the world. And the most recent lessons, I would say, are very important ones. If you think 2-3 years ago, and even at the beginning of the pandemic, most people in the Western world thought, well, the Chinese model is kind of superior, right? Superior in terms of managing lockdowns. It's more effective. They will go through a hard lockdown, but will be the first to recover. And now we see it's just the opposite, because this regime is unable to correct itself. Whereas in democratic systems, you have the huge advantage that it's no question whether the government loses its face or not. You just exchange the government if it goes further in the wrong direction. And hopefully, but at the end of the day, it's the narratives that are important, right? Through which lens do we look at the world economy? Do we interpret what is going on in different countries in the right way? And I would even say, prior to the pandemic, people interpreted the Chinese model in the wrong way, because they thought, well, it is the authoritarian approach that guarantees growth in this country. But maybe you disagree on the panel, but I think there are good reasons to say that it were the private course of the Chinese economy that produced growth over the most recent decades, and not the governmentally led investment decisions. Yeah, but here in the Western world, the narrative was very strong. Well, it needs more guidance. It needs a master plan of a centrally planned economy. Yes, some private initiatives are welcome, but at the end of the day, it must be the government to take the key decisions. And then the private economy kind of follows. Okay, but this was just a view. I should rather focus more on moderating rather than giving my views. Jörg, Christopher, if you feel that you would like to intervene, please raise your hand or just start talking.
Yeah, I'm happy to. So let me come back to China. So I would like to echo what you just said. Indeed, the narrative we've seen for a long period of time has indeed been that the success of the Chinese economy is due to the Chinese government. You could easily make the argument, maybe it's due despite the Chinese government. So simply you have a big market, you have a lot of private initiative that comes out. You rightly said that, say, the overwhelming majority of assets is still held by the Chinese government. And these are the assets that are least productive. So this is where no innovation comes from. It's really where maybe lots of people are employed, but it's not a productive part. So I think this indeed gives also to me hope that we start understanding anew that the private system has so many advantages. And maybe let's also think a little bit about the reactions companies have had towards the Russian aggressive war against Ukraine. We saw lots of complaints following the start of the war. How dependent are companies on gas? And now we see all of a sudden extremely fast, extremely comprehensive adjustments that are possible in this system. So one example I think that was cited is that Mercedes-Benz just reduced its gas use by 50% within half a year. And this gives me also, in light of all the the depressing news, it gives me hope that the system can react and will react to it. However, this may not necessarily mean that also all the from a macroeconomic perspective, this translates into equal gains. So it may simply be that companies decide to not stay at, to use a German word, stay at the same Standort, but simply go for other Standorte, which they need to use in a flexible way on a business perspective, which may not be equally good on an economic perspective. So this means also governments still have to provide the right framework in which things can operate. And in particular, when it comes to China, to remind also China and other parts of the world of the same rules to be applied, and so to say, to have the same rules that govern economic behavior or business behavior around the world.
Yeah, so I have a couple of things there. The First, and I'm going to make a broad sweeping observation, which may not be accurate or fair, but if you look at these central governments, these economies that have been controlled by a central government, typically it's a function of time. When do they fail? Not if, but throughout history, central managed governments have always failed because someone had a great idea and then went overboard and then it failed. I think Japan, and this may not be a popular view, basically since the 1990s, or even the 80s has failed. When they had the asset bubble and they bought everything, and then the Nikkei was at 39,000 and it's still in the 20,000s, 35 years later. Over the last 40 years, their GDP growth has averaged less than 0.5%. It's been a disaster, even though there's been full employment and no one went bankrupt and nobody wrote off assets. It's just been a really bad thing for Japan, where they were deemed to be, the economic powerhouse of the world. They are the only country that has this massive overhang in debt. Their federal debt is something like 250% of their GDP. They've gone through this yield curve control for the last 10 years or so, where they're keeping interest rates at 25 bips, and they've been trying to hold the currency. And now there is no bond market. There is the bonds that are owned by the government. I think the government of Japan owns more than 50-60% of the total bonds issued, and it's the emperor without no clothes. This will collapse. It's not a popular statement. We saw that they were defending the yen for a while, and then it collapsed. It went from 122 to 145, and it broke 145. And then they came in with basically an unlimited bid to get it back to 145. And I don't know where it is today, 143, 147. But the problem is that many of the central bankers around the world are saying, "Oh, that's a successful strategy. Let's do that." This, modern monetary theory. It is not going to work. Janet Yellen, the Secretary of the Treasurer, who's a political fob, just yapping what the current administration wants, is saying this is something that works. And by the own estimates, and forgive me for going on, but I think it's important. The United States is about 130% of its GDP is in debt, and the current interest rate on the current debt that we're paying is about 1.7%. Now think about this. In the next 5 years, about 50% of the U.S. debt rolls over, and we're at an average of 1.7. Where do we go? 4%? I mean, what that does is right now in the U.S. economy, we have our ability to fund our debt when we take a look at mandatory spending plus defense is 0.8% of our debt coverage. That's just debt coverage. So what that means is we have to issue more debt in order just to cover our mandatory spending plus our defense. As the interest rate rolls up, assuming it does roll up, we go from 0.8 to 0.6, and this is by the Congressional Budget Office. That's relatively independent. And these numbers just get worse. Within 10 years, we are at 0.2%, which means this is a disastrous compounding problem. Now, it's a big problem for the United States, but it's a bigger problem for everybody else because, again, we've got the dollars, the world's reserve currency, and what we do, we can kind of do it for ourselves, and everybody else in the world gets hit because of our irresponsible government and spending. And, there's a lot of feel good out there, and there's a lot of reasons to be optimistic. Quite frankly, I'm an optimistic person. I feel good. I know how to position assets to protect myself against this onslaught of debt that something is going to break. And it's not going to be the United States first. It's going to be some other country. And then everybody will get religion, and there will be some change that will be made. But the last point is, since the Roman empires, every government eventually has overspent due to social problems or wars. And every government's solution to overspending has been debasing the currency in one form or another, whether it's 5 or 6%. I was going to say 5. I thought that was too aggressive. You said 6. Thank you. It's going to be a problem for the world. So we need to protect ourselves against that, know that it's coming, not be surprised, not listen to the happy talk by the short-term market traders because they just want to trade for, next week's P&L. And be really thoughtful. So I'll pause.
Wow, that was rather the gloomy side of the outlook, I would say, or realistic side. I don't know, probably both. Let me raise another subject in this debate, which in particular for the European side is important, but it would also affect the US side. And this is what is going on in energy markets in the upcoming years. Let's suppose that Russia stays out of the world markets, at least out of the Western world markets. Therefore, Europe will depend heavily on LNG, which then comes from the rest of the world. So extra demand for LNG from Europe will drive up prices in the rest of the world as well, as long as we are all playing according to market economy rules. This will take some time, but I think global arbitrage will just do its job and drive gas prices up all over the world. And what is left is then only the delta between the delta that comes from transportation and lubrication, etc., extra cost. But it's only this delta which then would divide our energy markets. Do you see the risk that a new protectionism pops up in the United States in the direction of let's not protect our economy from imports, but rather let's protect our economy by not exporting energy to the rest of the world in order to keep an energy price advantage, which would then strengthen, in particular, the manufacturing sector in the US. So could the same Donald Trump, who campaigned for more LNG exports in his last presidency, be the same person who would then campaign for let's stop LNG exports to the rest of the world in order to build up a more powerful manufacturing base in the US? Is this a real risk, or am I just too nervous about that new protectionism that might be on the agenda?
Well, I don't think that Donald Trump is going to be protectionist to try to pump up the American industry versus the world. I think that the single largest challenge we have in the United States, we have, crazy laws with refining and shipping from here to there, and you have to use a U.S. carrier, and none of the U.S. flagged boats can actually get into the port. So we got kind of problems. There was just about a month ago where we had a lawsuit that was by the Environmental Defense Fund, which is 150 lawyers with 650 actions that are basically suing everything everywhere with an aggressive public relations campaign to shut down energy production. And then, of course, Joe Biden says the energy people are terrible, but it's the court systems and these aggressive, incredibly well-funded billion-dollar lawsuit machines that tie up things and require, a million-word document by a federal government in a permitting to be reviewed word by word, and it takes 4 or 5 years to get done. So I definitely fear that there will be some protectionism, but it will be because we want to keep our gas prices lower. And I think the rest of the world, the arbitrage between the TTF and the Henry Hub, the European gas and the US gas has to close. But I don't think it's going to close as fast as it should. And people are using all kinds of other stuff, whether it's wood chips or coal, and they're saying natural gas use is coming down, but the CO2 emissions are still going up. It's a real problem. I don't think it's Donald Trump, but it's a problem.
So I agree. So let's say even if we completely take out Donald Trump and let's see whether he will be reelected or not in 2 years, the one part where I see really or I have a significant concern regarding protectionism is the current Inflation Act in the United States, where we see that on the one hand, a right decision is made to really foster sustainability to the extent possible. At the same time, to actually really make a difference between, say, when it comes to car manufacturers, between US manufacturers and non-US manufacturers. And this is really the type of protectionist element that really should be dealt with very carefully. because it could right away lead to a race in which it's then again coming back to, say, a competition or say even a confrontation between Europe and the United States at a point of time where these two significant economic areas should be rather integrated rather than protected from each other.
Yep.
Right. Thomas, your take on it. Is there neo-protectionism, the spiral of interventions and counter-interventions from both sides of the Atlantic, is it a key risk for the upcoming years? And if so, what could we do against it?
Yeah, I'm not so worried about the energy sector when you talk about US-European relations. I mean, the US is basically self-sufficient as far as energy is concerned. The problem is more Europe. I mean, we have made in Germany a huge bet that we always get cheap gas from Russia. This has got wrong. Fragility, non-diversification, a classical example. But we need to import energy from elsewhere, and our natural supplier is the Middle East. So we have to come to grips somehow with these big exporters, and that's a political problem. Of course, they have an interest, like the Qataris, to make long-term contracts for energy. But here in Europe, and especially in Germany, our green economics minister says we make only short-term contracts. So we have a big political problem. But what that will somehow resolve itself, right? When we go to brownouts, blackouts, and whatever, and cold winters. But what I'm generally more worried about is that we see a new geopolitical division of the world. I would almost call it Cold War 2.0. So the conflict between the US and China is really the driving force. I can imagine that we will have a several layered world trade system in which simple products are still exchanged without much protectionist issues. Always assuming that China now does not invade Taiwan next week, right? This is always the Damocles sword that hangs over our heads, then we are in a totally divided world. But let's assume that they have some reason and don't do this. We only have the Russian war, the Ukraine-Russian war. Then I see from the US-Chinese relation this sorting out. So simple products, okay, we exchange. More sophisticated products up to a point, and security-relevant products, no. Right? So this is going to introduce here, I see a new division in the trading system. I would hope that we in Europe, and of course the American counterparts, would realize that Europe and the US in this new world are in one boat. That's the hope. I'm not very hopeful that this will be realized. I mean, if you can't even have a trade agreement with Canada, who are the better Americans from the European point of view, how should we ever be able to come to grips with the US? But we ought to, and we ought to include Japan in this as well. That's a pretty big market, right? Then we can kind of deal with the sort of semi-permeable divisions that we then would see between the Western world and the Chinese-dominated world, because I think this is going to be the end result. It's going to be a Chinese-dominated world, with Russia being the bulldog of the Chinese, which at some point they give a longer leash and sometimes they can roll it in. And so Chinese-dominated world and a Western-influenced world. If we realize that this is the future, then we should try to overcome across the Atlantic our petty divisions that we sometimes sort of indulge in.
Okay, well, this brings us already to the end of our 1 hour short debate, but I think with very important insights. Thank you very much for sharing your knowledge with the rest of us. And I think, Thomas, I can give the floor back to you for some concluding remarks.
you very much, everybody, for participating actively in the discussion. For me, very, very interesting. Now, also looking as a German living in the United States from the other side of the fence onto what's happening in Europe now. It is, I think, for us as the IWS and the members, very, very important to understand the global impact of these tightly knitted networks. And I fully agree with what you said before, is that obviously open structures are, much more efficient in dealing with change than these rigid structures we see in China and maybe even in Russia. Let's hope that our government is also seeing that and is not trying to push our country, the country Germany in Europe, towards more a rigid government-controlled structure than versus an open market economy. But I would think and I will hope that we are seeing that this change will spark plug, obviously, entrepreneurship and also businesses to take more control over what's going on in their respective countries. And therefore, we're very hopeful. Also from the WEC side, we see in our members that, there's a lot of hope for change in the world. And again, thank you very much to all of you for participating in this discussion, especially to the speakers. And I'm very much looking forward to the next roundtable, the virtual roundtable we're going to have, and obviously also our year-end celebration for 2022 in Berlin. And I would like to say goodbye from Washington to everybody and have a great day. Thank you.
Bye-bye.
Bye.
Thank you.
Thank you.